Hello, everyone. Welcome to our Wednesday Q&A. I'm Eric Griffin, president of ITM Trading, of ITM Trading,
You're
of
thinking
ITM
about
Trading.
night.
With me, I have Lynette Zang, our chief market analyst. We take your questions for our Q&As. You send them to us via email to questions@itmtrading.com. We ask them live, put them on a screen in front of us, so you get a real, true, organic, spontaneous response.
Yay.
Yay.
Let's
That's
just
how
dive
we
right
like
in
it.
while you're still awake.
All right, Pamela H. asks, and we get actually whole life questions. We get this a lot.
Okay.
So, will whole life insurance policies that can be borrowed against potentially be negatively impacted or wiped out in this upcoming financial reset?
How many words do you want me to use? One?
You can use
Yes. Yes. I know a lot of people do whole life policies because they kind of view it as a way to save, right? It's not the most cost-effective way to do it.
one, right?
Because
Because
really
the insurance fees are high.
very high.
But you do get the death benefit. A lot of people do it for estate planning because they get the death benefit, and they get and you don't get any downside risk to the market, right? You can never lose principal, but you're capped on the upside, right? So you might only be able to get 15% on your investment, but if the market does 20 or 30, the insurance company keeps the rest. So that's why people do that, in case you don't know.
Right. But the answer in a nutshell is yes. And keep in mind, too, that people think that all things are, they said it's guaranteed. Well, if you read the fine print, it says based on the claims paying ability of the insurance company.
Yeah. Well, and even if it is guaranteed, let's say they do everything that they said they're going to do. If it gets to a reset, it's hyperinflation first.
Right.
So it'll be super easy for them to meet their obligations because the dollar won't be worth anything. So if your policy's worth $10 million, but a loaf of bread costs $5 million, here's your $10 million. Whoop-de-doo. So yeah, it absolutely can be wiped out. Hyperinflation will wipe out
Any fiat money, assets or instruments, absolutely, 100%.
But if you have enough gold and silver in your portfolio to offset those losses, that's the goal. That's the whole point of owning gold and silver. You're not buying it for investment. You're buying it as an insurance policy so that you can have your assets in these other things and cover yourself.
Now, the fact of the matter is that gold and silver are severely undervalued. So that creates opportunity as we're going through this reset, and as the gold and silver, the nominal value starts to go toward its fundamental value, which is much higher than where it's trading now.
Well, let's say it was at its fundamental value now, let's say 12,500 an ounce, right? Even if it wasn't undervalued like it is, right? Fundamental value 12,500, right now it's around 1,900, undervalued. But even if it was at 12,500, in a hyperinflationary reset scenario, you're talking about gold that could be 50,000, 100,000, 200,000, a million.
5 trillion. Right.
Just like in Germany in hyperinflation, it was 87 trillion Deutschmarks for 1 ounce of gold. It started at 170 Deutschmarks, and in 4 years it was 87 trillion for 1 Deutschmark. So even if it wasn't undervalued, gold retains its value during that period of time, goes up dramatically while fiat money evaporates and real assets plummet in value, and so the opportunity is to take that $87 trillion and then buy undervalued assets so that when you come out of the reset, you're on the better side of it.
You're learning so well.
That's right. I listen, digest, take it in.
Love it. Love it.
Yes. So, here we go.
Okay.
Let's find out what we got next. Jesse L. asks, it's clear to me how inflation harms a population, but how exactly does inflation enrich the central bankers and their friends?
That is a great question, Jesse. Well, if you think of it like a wheel and the hub of a wheel, right? So you've got the central banks in the center. When they create new money, it has the most value that it will ever have. So who's right around the hub of that wheel? That's corporations. So banks, which are actually corporations, and other corporations. And then after that, it's the government. And by the time it trickles down to you, it's lost a lot of its purchasing power value. Though by the time you get it, at that moment, it does have the most purchasing power that it ever will. But in the meantime, these corporations that get it first when it has the most purchasing power, I mean, you can see how it benefits the 1% in that K-shaped recovery that we haven't really finished with yet. But they get to buy those assets with dollars that are then devaluing. You don't have that same luxury because you don't have access to that debt at the same levels or at the same timing as the corporations. Additionally, you know, when you talk about their friends, corporations wanted to pay you less and less and less. But they knew that if you were used to getting $10, you weren't going to accept $5. If, however, that $10 spent like $5, take a look at how the productivity, how the division between income and asset valuation has really risen for the top 1%. But look at the 90%. That has gone down. So they just get to buy these assets with cheap money. And you don't even really have that option. And they get to pay you less, even though, you know, because it creates nominal confusion, it looks like they're paying you more. Back in 1970, the average
income?
No, not
Family?
the average, the wage to the CEO, to the average worker was 20-1. Now, the last time I checked, it was averaging 360-1. But in a lot of cases, like say Bank of America or Chase, it's like 1,000 or 3,000-1. Well, where did they get all of that money to make that expansion? Inflation helped them do that. Because the corporations are earning more, but in reality, they're paying the workers less. And once they started paying the workers more, well, the Fed comes out and says, oh, no, that causes inflation.
Yeah.
Right? I mean, that's a whole nother discussion, but that's how it enriches. And for governments, it enables them that inflation tax is a tax that they get to issue without going through legislation. And you need to be clear. Inflation is not a monetary phenomenon. It is a fiat money phenomenon. So, was that clear?
Yeah. Another way that occurs too is like because they have access, the people who get access to the funds first can buy assets, and they can buy more assets. They have access to it. They can buy the assets, and inflation in a somewhat healthy economy, right? If you're buying up property, if your corporation's buying up property or stocks, let's say, and those assets are rising in value because you had access to that money first at cheap rates or whatnot, then the inflation is going to raise the value of all those assets that corporations and banks own and make them more valuable, right? So that's another way that's inflation is, because they're owning the assets, the inflation is making them wealthier.
Right. And if you even look at what happened in 2020, which they couldn't go back to what they did in 2008 and just bail out one sector, but they kind of did, but people didn't see it. So they stimulated the public. They stimulated the corporations for sure, and they're the ones that benefited the most.
Right, and they got the most because of the PPP programs and stuff.
Exactly.
Yeah.
But why did they inflate the population? I think it was for two reasons. Number one, because if they attempted to do what they did in 2008, they would have had a lot of people complaining about it. Mm-hmm. But also, we're a consumer-driven economy. So if the consumer doesn't have money to consume with, we got a problem. So they gave them that money so that consumers could continue to consume. And have we not heard up until recently that's now changing? But what we've been hearing is how strong the consumer is because of all of the savings and how they paid off their debt. Now they're regrowing that debt.
And the moratoriums on
mortgages, student loans, all of these things were about
rents.
Consumers exactly being able to consume, which supported the corporations that didn't just raise prices in line with inflation, but it was called greedflation. However, it's the rise in the wages. That's the real problem, and I hope you guys realize I'm being facetious.
All right, so Bill B asks, as the fiat money expires, will the coins we're currently using retain any value? So he's not speaking, if we're saying currently using, he's not speaking of junk silver. So there's no like base.
And there's not even
monetary
any copper,
metal in it, yeah.
Right? And there's not even any copper in the pennies anymore. So the answer is no. They're not going to retain any value. And really, how many people actually even accumulate the change anymore? It's more of a pain in the neck.
Yeah, well, even if you had a ton of it, it's going to spend the same as the regular fiat money. So no.
Yeah.
No retention of value. The only thing that would retain value would be gold coins or silver coins, because those are, precious metals at their core.
And they're precious metals, and they're used across the every sector in the global economy. So, yeah.
Yeah. All right, Denise M. asks, traditionally we've been told not to have more than 10 to 20% of our assets in precious metals. The purpose of this advice was basically not to have all your eggs in one basket. For the average retired person, do those percentages still make sense?
I don't think they make sense for anyone, to be honest with you. But you always have to do what your level of comfort is. I'm personally all in, but then again, I've been in these markets on some level my entire life. And so I have a really high level of comfort with tangible assets, gold and silver.
Plus you have income that comes in regularly too to sustain your lifestyle.
Correct. But if you're talking about retirement, you really have to be careful. That's part of the strategy is how do you replace that income? Because what you're really doing in here is you're subjecting your principal to risk. And you need to be able to live another day. So, you got to look at everything as a whole. There's really no blanket answer to this, but I prefer to have most of my wealth in an undervalued asset that's in a long-term positive trend, and the least amount of my wealth in an overvalued asset or instrument that's in a long-term negative trend. You know that you're in a negative trend when you see a series of lower and lower highs. Because if you keep getting lower and lower highs, you're going to get those lower and lower lows. Look at the purchasing power chart. Because that's the real trend. Not the other stuff, not the stock market or the bond market or even the currency markets, which is one currency against the other. It's what you can convert that into. That's the real trend that matters. So, Denise, I would say that you really need to talk to one of our consultants, and I think the Calendly link is below, and look at your whole picture and then determine what strategy fits your needs so that you keep getting that income that you need today, but that your principal is protected so that you can live to fight another day as hyperinflation takes over. You don't want to lose it. And what are you getting? I mean, you're getting a little bit more now, but maybe 5%. So you're going to risk your principal for 5% that goes away. You really need to have a properly diversified portfolio so that no matter what happens or no matter where we are in this cycle, you are fine. Forget the percentages. Think about your goals and what you're trying to accomplish.
Right. And then you can determine how much gold and silver you need and what types
and
of
cash.
Gold and silver that you need, right?
Right. And cash too. That's got to be part of that portfolio. But it's that's why we do custom strategies. The strategy is the same for everybody. It's basically the same. But everybody has different needs or at different points in their life, and they have different goals. So we can account for all of that. We just need to understand it, where you're coming from, what your goals are.
All right, so Tony D3276 asks, why is the price of gold dropping? If central banks have bought more gold in the first half of this year than any time in history, shouldn't this demand drive the price up? I've heard many say they are suppressing the real price of gold. It seems like it, but how do they do this?
By what? Okay, so I love this question because the reason why gold is dropping is because a rising gold price indicates a failing fiat currency. And once you understand that, then you make different choices. So central banks have to suppress the true fundamental value of gold because otherwise you would not be you would use it for barter, but you would be accumulating gold, taking your wealth out of the fiat money system and making it invisible to them. So it's easier for them to confiscate your wealth as long as it's in the system. So the price of gold is dropping. The way that they do this is actually quite simple. The spot market was created in the 70s to manage the price of gold. And through those spot contracts, they can create as much gold and this is true for silver too, as much gold that does not nor ever will exist as they want to. The numbers are kind of hidden, the real numbers, but before the central banks really jumped heavily into the derivative market, which is when they changed the accounting formulas, I saw with these eyes, I didn't know print screen at that time, but I saw with these eyes that for every 1 ounce of gold that exists in the world, because there's a finite amount of this, that globally they had created 62,000 ounces of derivative gold. That's gold that does not nor ever will exist. So if the markets think that there's 62,000 ounces of gold that's not real, do you think that could have an impact on the visible contract spot price that you see? 100%. And it's not even very expensive. $150 controls 500 ounces of gold, 5,000 ounces of silver. You can do the math on that, but that's massive leverage. And if you're a central bank, it's 110. Now, I haven't checked the prices. The prices might have changed recently, but they're not going to change that much because they don't want them to change that much. They're trading it. They're using, even the OCC, I brought this up the other day in a meeting and everybody looked at me like, what is that vegetable soup? But I use this all the time. So you guys have this link, and if you need it, contact one of our representatives and tell them you want the report, or you can go in the Office of the Comptroller of the Currency, so the OCC, on a quarterly basis runs a report on derivatives in the FDIC insured banks. They do it every single quarter. You take a look, and when you pull that report up, and you'll see whatever the most current report is, if you do a Control F, so you're going to look for it, and just put gold in there, right? And it'll take you to a chart that shows you the reported notional value, which still doesn't tell you the amount at risk. But anyway, it does maybe tell you the market value of the derivative contracts in gold. Take a look at that. It's eye-opening. And take a look at there's so much to this, Tony. I'm telling you. But it is so easy to manipulate because this is not a true supply and demand market. This is a trading market. If you want to know the true supply-demand market, then you go into the physical-only markets, and that's where you see the truth. Because you see the spot market drop because, hey, they can create as much gold that doesn't exist as they want to. But in the physical world, we are seeing, especially up at the rarefied levels, brand new all-time highs in physical gold and silver. So you ain't getting the truth from the spot market because it was designed to manage your perception of gold and, frankly, to keep you away from it. Anything you want to add to that, puppy?
Well said.
Thank you so much. So again, these are great questions. And if you haven't started your gold and silver strategy yet, click that Calendly link below and get your strategy not just in place, because a lot of people go, oh, well, I'm talking about it or I'm thinking about it. Well, you got to execute it. That is critically important. And that's your foundation to make sure that you can retire or protect what you've accumulated or position for the future. But you also need a little more than that to sustain your current standard of living. Yes.
And the strategy is how the types of gold and silver that you need and the percentages that you need for your goals and objectives to survive and thrive during a reset. We get people asking questions all the time if we could help them with a strategy that has nothing to do with gold and silver. Just so we're clear, it is gold and silver based.
Right. If you want the rest of it, the rest of the mantra, food, water, energy, security, food, water, energy, security, barterability, wealth preservation, community, and shelter, you go to and subscribe to Beyond Gold and Silver. Make sure that you join that. But if you're also feeling alone because your friends and family don't see what you see coming, come join us at thriverscommunity.com. Become a member and help us build that community that you've been looking for. This is the opportunity to get in on the ground floor and make it look like what you need and help us. You know, we are all in this together. So it is critically important that we come together in community because we vote with our wallets, we vote with our purses, we vote with our actions. And we need to come together so that we have choices. And again, if you like this, please give us a thumbs up. Make sure you leave a comment. Make sure that you subscribe and share. Because this physical gold and silver is your wealth shield. And ignorance does not make you immune. So you want everybody, as many people as possible, to understand what you know, what we're trying to help everybody understand, so that we got a shot at having a more fair monetary system on the other side of this. And until we meet next, please be safe out there. Bye-bye.